Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to the show, Charles. Appreciate it.
Thanks. Very good to be here.
You know, I'm wondering, for fun, for entertainment on TV, have you been watching the Republican debates?
Oh, I've been watching every single one of them. And, you know, as I always tell people, if you're ever really bored or need entertainment and Saturday Night Live is not entertaining enough or funny enough, just watch the Republican primary debates. Pure entertainment gold.
Oh, my God. I didn't catch it, but I saw some of the replays. I'm like, this is crazy.
It is not surprising. The good news with the one last night, the fourth one, is it was only 4 candidates left on stage. So they actually did have, in part a reasonably substantive policy discussion around some key issues. And then there was the usual, entertaining piece of it. But yeah.
Yeah, it's amazing kind of where we've come in American politics, I think. But interesting. Nonetheless, we'll see how 2024 plays out. And it's sure going to be something I want to talk to you about as well. But right now, let me welcome our guests. Welcome back to another episode of Trends with Benefits. I'm speaking with Charles Myers, who is chairman and founder of Signum Global. And Signum Global works with companies to anticipate and assess policy agendas that may have a material impact on markets, sectors, and asset classes, and producing predictive research and market insights. Again, Charles, thank you. Welcome to the show.
Thanks for having me.
I will admit I'm going to have a hard time not calling you Charlie, so don't hold that against me.
That's all right.
All right. But no, I'll call you Charles. One of the things I've really been looking forward to speaking with you, because I love talking to guys like you that have I'm assuming, and I'm guessing you do, have a very broad perspective of what's happening across the world and the globe and in markets. And, for somebody like me, John Doe investor, kind of boots on the ground, kind of going about my day, inundated by local news and whatever curated news I get on all the various channels, I think it's real easy to just kind of become myopic about what you see or what I see. And so I guess my goal today with you is to help broaden my perspective and kind of make sense of the global cross currents and what that might mean for me and my portfolio. How's that sound?
Sounds great.
Now, your firm, Signum Global, maybe you can tell me a little about it just from background purposes. I kind of gave a little description, but global macro research, how many analysts, that kind of thing?
Yeah, great. I started it 5 years ago. I was on prior to that, I was on the sell side for 27 years, did emerging markets for about 20 of those 27, did the U.S. equity market for the last 7. But after 27 years on the sell side, I really wanted to focus more exclusively on these big macro and geopolitical volatility events that are happening much more frequently. Everything from COVID to the invasion of Ukraine to Israel-Gaza, all these very big issues that are driving volatility in the markets. And so I set this firm up. We're now 14 partners: New York, Washington, London, Dubai. We do predictive research. We do a lot of access with elected officials to get our clients in front of the people that are drafting and voting on legislation or making policy, and we're consultants. So we focus on macro and geopolitical risk.
Now, you said something that was interesting. You said wanting to cover these geopolitical events that are happening more frequently. Why do you think there's more of these things happening more frequently?
Yeah, it's a really important question. It's also a really good way to set up, I think, this discussion for the next hour, which is, for the last 40 years before the invasion of Ukraine, I would argue that we lived through a golden age in many respects, including a golden age for investing. It may not have always felt that way, but we will look back on the 40 years before the invasion of Ukraine as truly a golden age, because we had the absolutely unprecedented combination in certainly modern history. I don't know about human history, but modern history, of two things. First, 40 years of no war. That's not that unprecedented. There are other periods of 40 years with no war. It was the second piece of this that was totally unprecedented, which was both global monetary and fiscal expansion on an unprecedented scale. So we had a peace dividend for 40 years, and on top of that, unprecedented fiscal and monetary expansion, where central banks and governments stepped in at any hiccup, let alone a crisis, and just flooded the markets with liquidity, with emergency programs, creating completely new facilities, new programs, literally around the world, often in a coordinated way. That helped risk assets, amongst other things. It also addressed the problems. Has created much bigger problems down the road. But my main point is that we are now in the opposite, unfortunately, of that 40-year period. We are now in an extended period of geopolitical conflict. The United States is at war with Russia. It's a proxy war. And we're also in an extended period of much higher interest rates. So we will look back on the previous 40 years as having been a golden age. You can still make a lot of money in this next, period. It's just going to be harder.
Well, as I think about this, or as I think about kind of the stuff that you do, and you mentioned Ukraine, that sounds like an almost pivotal moment in history. Maybe you could talk a little bit about why that is specifically, but let me back up a little bit because I wanted to ask you from a different perspective, and this might be a little silly, but imagine you're a man on the moon sitting on a rock looking at Earth and looking at all the things going on, all the different countries, geopolitics, trade, and you're interested in making an investment. Where do you start?
Yeah, look, I think where you need to start is from a framework of being more defensive, perhaps than in the past. You can still, buy or invest in growth sectors and growth areas. And clearly, in being invested in the top 7 or top 15 tech companies has been the right call. U.S. tech companies has been the right call this year. So you can still do that, but you also need to be a little more defensive and positioned more defensively. And as part of that, I would argue, be much more focused on and aware of the potential for geopolitical risk. The single biggest change since the invasion of Ukraine is the absolute necessity of anyone that's either managing money or managing a company to now try to factor and be aware of geopolitical risk and factoring that into their decision-making process. So I think that's the biggest change. And it's something that's quite new for people. For 40 years, you didn't really have to do that. And now it's got to be front and center, or at least an integral part of your decision-making process.
And who or what region is most important in that calculus? China? Is it Russia? The Middle East?
Yeah, unfortunately, I wish I could say one because it's pretty global, right? So, we're in an active war with Russia at the moment. It's a proxy war, but we are actively engaged. The U.S. and NATO, the Western Alliance, we're at war with Russia. Israel's now at war with Gaza. Let's, hope that doesn't become a bigger regional war. That our call is it won't, but it's still a very volatile situation. And then you have U.S. China, which is ongoing, and people like to call it a conflict. Sorry, they like to call it a competition. It is a conflict. And I'm sure we'll get into that more later. So it's truly global. And then we also just need to be mindful that you have some other hotspots like military coups going on in Africa, for example, the rise of right-wing governments in places like Europe. And lastly, very importantly, North Korea could surprise us. It is a very global framework that you have to be kind of looking at as we are now in this other paradigm, unfortunately.
Now, is U.S. China relationships and those tensions preeminent in all of this, or could we start there?
Absolutely. And I would say that probably the single most challenging call to make sitting here today is what do you do with China? Meaning, whether you're a portfolio investor or you're in the C-suite and you already have operations as most multinationals do in China, meaning do you invest more? Do you just sort of stay on pause where you are now? Or do you continue to do what most investors and companies are doing, multinationals are doing, which is de-risking, which is just a euphemism for moving your supply chains out or going underweight the market, right? The Chinese market. It's the single most challenging call because the market, let's just stick with the equity market for the moment. The Chinese equity market has been hit so hard, right? And so there are, and people are very split on this. There's a lot of, a pretty large number of China bulls out there now saying that more than enough bad news is priced in and it's time to start investing in and buying China. That could be right. I think in the short term, China could surprise us with maybe more stimulus. At the moment, they're drip feeding stimulus in. I think they might be able to, because being a centralized command economy and a dictatorship, they can do whatever they want. And they have in the past shown that they can. And so they could surprise us in the short term with more stimulus. They are going to get the property sector or the debt in the property sector resolved. That's a longer term issue, but they are tackling it. They're actually creating a stabilization fund to buy equity. So they're going to prop the market up a bit. So they could surprise us in the short term. The challenge, I think, with China is it's probably medium to long term, the biggest structural short in my career. What the Chinese government is doing in so many ways, starting 2.5 years ago, all under the guise of or auspices of common prosperity, their term, which is really just another word for forced income redistribution. But as part of common prosperity, in addition to some of the good things like cracking down on corruption, what they have done is used that sort of ideology in a way to exert more control, more political control. And so the first major move that they made, that the government or the CCP made, was to crack down on their tech companies or any company that has access to data. So it wasn't only tech, it was the ride-hailing company Didi. They forced them to delist from New York. That was a decision in Beijing. Online education companies, gaming companies, any company that has access to data. And in that process of cracking down on these companies, they inflicted about $1.5 trillion of value destruction on literally self-inflicted but intentional, mainly on foreign shareholders who were the biggest shareholders in a lot of these companies. So that's just the beginning. Since then, they've been raiding the offices of foreign companies in Shanghai and Beijing. They've been arresting foreign executives, not to mention disappearing a number of their own, Jack Ma for quite a long time. Journalists are being disappeared. Actually, former defense minister has been disappeared. They've been doing things that have really been creating a much more hostile environment for foreign investment. And so my point on that is that's just on the portfolio investment side. Very quickly on the foreign direct investment side, with the exception of Apple and Tesla and some really big companies that have to be there, the domestic market's so important. Almost every other major multinational is in the process of trying to figure out how to move some of their operations out of China or not invest more. And lastly, I'd say one of the many structural problems that China has, youth unemployment of 27%, demographic problems, leverage problems. One of the other big problems is that foreign direct investment has not returned to China since they reopened post-COVID, and it's not going to. In fact, the year-to-date data is net disinvestment out of China because of the diversification of supply chains. China has huge structural problems. In the short term, they could surprise on the upside. I think medium to long term, it's still a structural short, and happy to get into the geopolitics of it as well, because it's just another layer and another dimension.
There's a lot of layers, yeah. But we have such interdependency with China, right? From on a trade standpoint, and I mean, do you see that diminishing over time as like foreign direct investment going down and things of that sort?
Absolutely. So China is the second biggest economy in the world. Absolutely, very important economy, very important for the world economy, for the U.S. economy. We do have so much interconnectivity and interdependency. And that's why when President Xi came to San Francisco 3 weeks ago, he was not only did Biden fly out there to meet with him, all the many major CEOs actually paid $40,000 each to sit at his table, at President Xi's table. So, it shows how important China is. Having said that, we're involved in a much bigger conflict, right? The overall conflict / competition that people like to use. We use these words like competition or de-risking because they sound more benign. But the overall conflict is on 3 levels, right? The first is, and just to be clear, the United States is actively engaged in a strategy of containment of China. It started under President Obama, and it was sort of implied and sort of weak. And then President Trump got elected, and like so many things with President Trump, he just blew it out of the water, and it became an explicit strategy of containment. He started a trade war with China. A Republican president, the Party of Free Trade, started a trade war with China. He ensured that Huawei, and therefore China, is not the world leader in 5G. All this, explicit strategy, and every president, including Biden's, only going to take it further. And so it's on 3 levels: economic containment, technological containment, and then geopolitical. And just very quickly on the economic side, my whole career, I was told and actually believed that the Chinese economy would overtake the United States economy. That has not happened. It will never happen. I'm willing to debate that with anyone. In fact, I think we saw or have seen peak Chinese economic power pre-COVID, and from here, it's a multi-decade structural decline. Secondly, on the tech, the United States, we have a tech export restriction list. We've made sure Huawei's a shadow of its former self. China's not the world leader in 5G. We're going to keep expanding that tech export restriction list to include AI, supercomputing, quantum computing, all kinds of other technologies. Lastly, on geopolitical, it all comes down to Taiwan and really curtailing China's geopolitical influence and power in the South China Sea. And we'll see how that plays out. But, this is a true conflict between the two world superpowers. And it's ultimately, for every American, I would argue, a battle over a battle for the future of the democratic capitalist way of life, American way of life.
Yeah, you mentioned China is kind of on an economic decline now going forward. What is that based on? Based on our policy of containment, or is it based on something more fundamental like demographics within China?
all of the above. And so, China has so many issues. Many of them are of their own making. And I think what we're seeing at a high level play out today, and for the last 2 years at least, is something that has happened consistently over time, which is that over time, a truly open capitalist economy is inconsistent with a military dictatorship or an increasingly repressive government. They're just incompatible. You can't have political control of your country, especially one as vast as China, and have a completely open capitalist economy. It just doesn't work. And the main reason is that the two biggest threats to a dictatorship anywhere in the world is first information or access to information. That's why they crack down on their data companies. And secondly is potentially losing control of your currency. So that's where it starts. And as the CCP under President Xi has been exerting more and more control so that they can stay in power forever, and he can be president for life. They've not only inflicted value destruction on so many of their companies, but they are, again, creating a much more hostile environment for foreign investors. And that's why so many are leaving or underweighting the market.
And for years, I've heard of China playing in different markets, particularly in the natural resources in Africa and what have you, giving money to governments there to control the natural resources that come out of various countries. And it seemed like a competition. Is the Ukraine war, for instance, kind of a pivot point where it seems like different nations are lining up on taking sides a little bit behind the scenes? Does that seem like what you're seeing as well?
Oh, absolutely. I think, of all of the things, the world changed so fundamentally in February last year when Russia invaded Ukraine. And of the many, many changes, some of which we are well aware of, there are still changes that and derivative impacts from that invasion, from the act of that invasion, that are going to be felt for years to come. And just to elaborate on, because what you just raised an incredibly important point, which is the invasion of Ukraine. First of all, the vast majority of the world didn't believe Russia would invade, right? If you remember back to February last year, despite Putin having spent months amassing troops, military hardware, blood supply, and incinerators on the border, literally the world was like, he's not going to invade. The only high-profile person that actually said he was going to invade and was shouting from the rooftops was Joe Biden, President Biden. In fact, we did something we've never done before. We shared our intelligence with the world, and they still didn't believe us. Even Zelensky didn't believe us. And then Putin invaded, and it changed everything because on several levels, one of which you raised just a second ago first, and I'll come to that, but first, it actually made the unthinkable the unthinkable happened. And so one of the things that we talk about at our firm is we're now living in the world of the unthinkable. Things that we couldn't possibly imagine happening are happening, and they're starting to happen more frequently. A major terrorist attack on Israel where you had hundreds of terrorists penetrating their multiple borders of their country and inflicting the kind of damage and destruction and death that they did inside Israel was unthinkable. But on Ukraine, of the other things where the world has changed is what you referenced. We've seen a hardening now of the two main geopolitical axes, right? The United States with NATO and our other allies, Japan, Australia, South Korea, and then the other axis, which is now much tighter and much firmer and much more aligned and cooperating with each other, which are China, Russia, Iran, North Korea, and then a few countries like Syria and others that are flirting with that or that are part of that. That's another big change from Ukraine. A couple other big changes is, Putin used the pretext of NATO expansion as an excuse to invade Ukraine. In fact, it was his invasion of Ukraine that led to the expansion of NATO because Sweden and Finland came rushing into the arms of NATO. So that's another.
Did he really expect that wouldn't happen?
Oh, the world didn't think that would happen. We have clients in both, Stockholm and Helsinki. If you and I were in Stockholm or Helsinki in January last year and told them, hey, you're going to join NATO, we'd have been thrown out of the room. So it shows you war changes everything. And the United States is at war with NATO, where the Western Alliance is at war with Russia. It's a proxy war. We will see this war through. That's why, as a quick aside, all this noise in Washington about Ukraine aid not passing, it's going to pass. The United States, the reason we will see this war through to the end is the United States, with our NATO allies, understand that Putin is an existential threat to Europe and therefore to the United States. Everyone now understands that had Putin succeeded in taking Ukraine, that once he had regrouped, he would have moved on Moldova and then the Baltics, right? That Putin is truly an imperialist and he has to be stopped. So that's one reason we will see this war in Ukraine through to the end. The second is that any failure in Ukraine, or if Putin succeeds and takes Ukraine, the Americans believe that would send a green light to China to take Taiwan. So for the Americans, Ukraine and Taiwan are completely linked.
And then the other hotspot right now, Israel and Gaza. What are the implications of that from a global standpoint?
So when the attacks on Israel happened on October 7th, we came out with a call to say that we thought Israel would show some restraint initially, right? That because the consensus and the view in the world was Israel is going to have a knee-jerk reaction and invade Gaza immediately, right? And just absolutely go in all guns blazing. And even the oil markets were sort of discounting that initially, understandably. The reason we thought that Israel would show some restraint initially was three things. The hostages are and were still alive at that point, and hopefully still are, but it was a major consideration. Secondly, President Biden flew over there personally to ask Netanyahu to de-escalate, right? It was a very symbolic, very important trip. The third is something that no one likes to admit in Israel or the United States, which is the truth is Israel was not militarily prepared for a full-scale invasion of Gaza, and also at the same time to protect the northern border if Hezbollah had decided to get involved in the war. It took about a month, and then Israel was ready with the help of the United States. We also had to go on high alert. All of our bases in the region, we sent 2 aircraft carriers, a lot of planes. We have 900 troops, American troops on the ground in Israel. So we and then Israel was prepared. They've now invaded and they will occupy Gaza. And it's going to take years. The Israelis don't like to call it this, but this will be a multi-year Israeli occupation of Gaza. And so to your question on the implications, for now, it's really just a relatively contained conflict between Israel and Gaza or Hamas. And I say that by saying relatively contained, I don't want to minimize the the horrible level of destruction and death on both sides. But we don't think this becomes a broader regional war, meaning Iran getting involved or Hezbollah for now. So I think the oil markets, have been discounting this correctly, which is oil's been weakening, and in fact is trading more on, I think, concerns about weakness in the global economy and therefore weakness in demand.
So I was gonna try to get you to comment on the tie to energy and oil, and I think Saudi Arabia was a couple of weeks ago committed to a production cut, 1 million barrel a day production cut. Will they maintain that through 2024?
Yeah, I think so. Saudi, as we all know, the oil market doesn't trade on fundamentals, right? And certainly doesn't trade on supply-demand fundamentals. It trades on very controlled supply, and it reacts to perceptions of future demand, right? And so, or also where Saudi really wants the price of oil to go. From here, what the Saudis and OPEC Plus will do, but mainly the Saudis, is continue to gauge the health or strength or weakness of the global economy. One thing that is really not helpful is weak China, right? Weak China demand. The U.S., if we do go into recession next year, although consensus seems to be for a soft landing, that's also a consideration. So I think the Saudis are pretty committed to keeping the price of oil somewhere around kind of this band, and we're probably near the lower end of the band, not completely at the bottom of the band, but I wouldn't expect oil to sell off dramatically from here. I also wouldn't expect it to rally much. I think they're going to keep it pretty controlled, and therefore, to answer your question, I think the output cuts remain certainly through next year.
If you can tie some of this stuff to asset classes, I wonder what would come to mind. Commodities, might they be soft to the beginning of next year or longer? Security and defense companies. Just looking about what we talked about, kind of where do you go look for opportunities?
Yeah, so I'd say there are a couple of big themes that are shaping up, looking out, beyond the short term, right? Just really looking out sort of for the next 3 to 5 years. And one of them, which is a very clear trend, is that we are in a super cycle for defense or defense companies. And the defense companies have actually been sort of weak this year after an initial run, after the invasion of Ukraine. But I would just view that as somewhat temporary weakness. The truth is, a number of them are clients of ours. The truth is, defense companies today cannot manufacture fast enough. They cannot manufacture military hardware fast enough to meet existing demand, let alone the demand that will be there after the war in Ukraine, for example, where we have to backfill all of the arsenals, including our own, right? Now you have the conflict Israel-Gaza, right? That creates even more demand, right? And that was unexpected, right? That was a surprise. And if China's ever serious about taking Taiwan, that's a whole other dimension of demand, right? A huge scale of demand. So I think we're in a 10 to 15 year super cycle for defense companies. And I think that on any weakness like that we've seen recently, I would be a very big buyer. This is a very long-term trend, and we're in the early stages of that. I think on commodities, commodities get bunched in as kind of one group, but as you know, there's just so many different commodities and different drivers. And so part of the call, I think, on a number of the commodities is your view on the U.S. economy, meaning, are we going into recession or not? If we're going to have a very soft landing or no landing, no recession, then I'd be pretty bullish on commodities. I am a little bit more in the sort of, it's going to be a bit of a hard landing, meaning a very deeper but short recession. Then in the short term, I'd be a little worried about some of the commodities.
What about weakness in China and its impact on commodities?
Absolutely. And we've been seeing that, right? Because the Chinese economy has been weak now really since COVID, right? And has not recovered. It could get a little worse, but I think we're probably near the trough in terms of Chinese economic growth in the short term, right? I think that from here, they'll do enough to kind of get the economy. It is growing, but it's not going to grow 8% like it used to. But I think that could help a little bit as well, but probably not enough to offset if we do go into recession in the U.S. We are still the biggest economy by far. The other two really big trends that we're spending a lot of time on. The first, it's early, but is the reconstruction of Ukraine. This war will end. All wars end, even if it's a stalemate or a frozen conflict. When this war ends, which we think is at some point late next year, they're starting to identify the winners in the reconstruction of Ukraine is going to be one of the top three global investment themes. The reconstruction cost, if the war ends tomorrow, is around $500 to $550 billion. If it goes through to next year, it could be as high as $750 billion. The biggest winners in that reconstruction are going to be European companies because of proximity. Ukraine's going to need big European companies that have the scale and the proximity, but can get in quickly. There's also going to be some preference given to Polish and Turkish companies because those two countries have been very helpful in the war in different ways. But after that, it's mainly Europeans. And then the defense companies. The other theme is playing the Inflation Reduction Act and what I think will be a multi-year economic boom in the United States, which again is going to be a function of government spending, $750 billion of fiscal stimulus from the IRA, CHIPS, and infrastructure bill, which is already flowing into the U.S. economy. One of the reasons the U.S. economy has been so resilient and we haven't had a recession yet is because of all this fiscal spending. On top of that, all the private sector investment and foreign direct investment. As a result, you get to $1.5 trillion of spending and investment over 8 years, but it can be front-end loaded because they're mainly incentives in the form of incentives. So I think that we're going to have a multi-year economic boom once we come out of recession next year. And I think it's really underappreciated. And as part of it, FDI, almost every major multinational today is rethinking CapEx or has made a decision to rethink CapEx away from Europe and Asia into the U.S. because of all these incentives. So I think that, if this is true, it in a way almost doesn't matter who wins the election next November. Of course it matters. But for whoever wins, Biden reelect, Trump, or if it's Kamala Harris or whatever it is, they're going to inherit an economy that is lifting off, which is hugely positive. Secondly, this, if true, is very dollar supportive. Because of all the FDI, especially. I think all the bear cases on the dollar will be wrong, not in the short term, but looking out 3 to 5 years. And lastly, it will be inflationary, which brings me back to what I said earlier, is we are in an extended period of higher interest rates, meaning when the Fed finally pivots to accommodation next year, Fed funds is probably going down to about 4.5%, right? We're not going back to 2% or zero. You can still make a lot of money. The U.S. economy can do very well with higher interest rates if the other conditions are there. We have historically, and I think the other conditions will be there on steroids. I think it's really exciting.
Yeah. Do you think, our inflation rate, the maintainable inflation rate is something greater than 2%? We couldn't go back to that.
Yeah, I think that in my view, or our view, I think the market is gotten a bit ahead of itself on the inflation part of it. What's really been driving the market this year are the 7 tech stocks, right? Especially the AI related. In fact, I saw a number yesterday that of the 15 top performing U.S. stocks, the market cap of those 15 names is greater than the market cap of Europe, China and something else all combined. I mean, it's like some ridiculous stat, right? And so that's part of what has driven this outperformance of U.S. equities this year. It's been very concentrated. Having said that, I think the markets also have gotten a bit too excited about the Fed's ability to bring inflation down to their 2% target, meaning I think this last leg of inflation is going to prove to be a bit stickier than what the markets have priced in. And secondly, therefore, I don't think the Fed starts cutting rates in the middle of next year. I think they're going to have to stay higher for longer, probably to the end of next year. And again, a more gradual rate reduction than what is priced in today. And lastly, QT is ongoing. We never talk about QT anymore, but let's not forget that that there is this quite aggressive form of removal of liquidity through quantitative tightening as well. So I think all of that, plus the consumer being a little more tapped out than some of the data suggests, and some blowups in commercial real estate that are coming, means that we're probably going to go into recession. Weak China also hurts a bit. But I think it's going to be Q1, Q2, and a little bit deeper than most people think, but very short because of all this all this other money that's flowing into the U.S. economy.
You mean there's more pain to come in commercial real estate?
I do. I think that, the biggest challenge with commercial real estate today is that the biggest lenders there are regional banks, right? The second biggest group of creditors, though, is private capital, private equity and hedge funds, and they have the unique ability to delay the problem, right? I mean, the growing the growing divergence of public marks versus some of the private equity marks on not only commercial real estate but on other parts of their portfolios, that divergence is huge, probably the widest it's ever been. And I think what's happening is even the regional banks, all the creditors are just holding out, hoping that the Fed's going to cut rates and soon. And when they do, that'll give them some breathing room. The truth is there's $1.5 trillion of U.S. commercial real estate loans that mature between now and the end of 2025, $1.5 trillion. You only have three options: pay it off. None of these companies can pay off their debt. Secondly, and they never do anyway, they roll it over. Secondly, roll it over. But if rolling it over, refinancing, instead of, the rate today of 2 or 3%, that you're paying, you're going to pay 7, 8, maybe even 10 to 12%, much, much more expensive, or third default. I think that we're going to see a wave of restructurings.
I usually hold off on asking a trend or fad question till the end, but I just can't resist right now, kind of given this discussion. Real quick, trend or fad, energy transition.
I would say trend, but very, very, very specific areas only. So just let me, I know you wanted a quick answer, but it's a really important question, which is, even before the war in Ukraine, I've been saying that we're not going to have a renewable revolution or a green revolution in the United States. In fact, Europe is in the process of it and will be further ahead of us, with the exception of EVs and solar. And so the reason I say that is because of what we were talking about earlier, which is our election cycle. We could have every 4 years a complete change in government. Given that, I think that what we are having here, it's already started and will continue to have in the United States, is an electric vehicle revolution. That is well underway. Republicans are on board with it, as they should be. And China is going to be the world leader in production of EVs. We will be number 2. And we're also going to have a bit of a solar, I don't want to call it a revolution, but much wider spread adoption. So it's going to be very narrowly focused. In terms of a much broader green revolution, or massive transition, Europe's going to be way ahead of us.
In terms of kind of broadly in the U.S., other things that are kind of top of mind for you that you think are important for investors to really understand going into 24?
Yeah, I think that, really trying to get the recession call right is going to be, a big call, just because there is no consensus, right? Like, consensus went from soft landing to hard landing. Then we went from, that to now soft landing or no landing. And now we're kind of back at soft landing. It's all over the place. And, it's not to criticize any, forecasters, but the thing is, it's been incredibly challenging because COVID has led to so many distortions in the U.S. economy and in the global economy that we're still feeling some of those distortions. And therefore, it's harder to predict, to make, economic forecasts. And so, but getting that call right or wrong, I think really matters, over the next 12 months. I think that we are heading into, again, a period of weakness, but coming out, we'll be looking very good for a multi-year period of American exceptionalism in every way, including in the equity market. The other really big issue in the United States, of course, is the November election, because if Biden does not get reelected, or if it is Trump 2.0, there are some very big changes coming Some areas where you can really make money. It's just you got to be prepared for that. And I think the election is going to be absolutely down to the wire and very close. So therefore hard to call, right? Right up until either the night of or literally the couple of days after.
Briefly, some of those areas you can make money. What are those? Depending on which way it goes, is it?
Yeah, well, I think if it's a Biden reelect, I think it's just continuity, right? And I think that it's really trying to play the Inflation Reduction Act, chips, and infrastructure. And so therefore, it's very targeted. You want to really be overweight because of this legislation, and the incentives are very targeted. You want to be overweight manufacturing. You want to be overweight semiconductors and renewables. But within renewables, again, mainly EV, solar, and things, technologies that are scalable and where there's a path to profitability. And I think if Biden wins re-election, we will get a CHIPS 2.0 bill, even more money to encourage companies, U.S. and foreign, to expand or build in the U.S. Chip manufacturing, because it's about national security. It was very bipartisan. If Trump wins, I think you really want to be hugely overweight fossil fuels and the entire kind of investment ecosystem around that. I'd be much more cautious on big tech. He's really hostile to he believes that tech companies are hostile to him, and that there's a very strong conservative bias amongst tech companies and everything from search to you name it. So I'd be a little concerned there. Although I think AI is real and will continue to drive returns. So I think that again, and then lastly on Trump, I think that one of the big question marks is, does he take the trade war further? And trade wars are incredibly value destructive, right? Trade wars only benefit a country politically. They really don't benefit a country economically because of the retaliatory tariffs. It tends to be quite value destructive.
Fantastic. One of the ways I close out is asking guests, what's one long-term trend you see playing out over the next several years? Is there something else that you find fascinating or interested in investing in, even kind of a thematic?
Yeah, I think it picks up on what I was saying, a little bit of what I was saying earlier, but just to fine tune it. If you believe that AI is as significant or as transformational as most people in tech, but also most investors do, and by that I mean, even if you take out the hype around AI, and there's a lot of hype, but if you believe that AI will be a meaningful driver of growth and productivity over the next 5 to 10 years. Every major AI company is based in the United States. The economy that will be the most restructured in the world by AI, meaning benefit from AI in terms of productivity gains, efficiency, et cetera, is the United States. So looking out on this, theme I was talking about earlier of American exceptionalism and wanting to be very overweight U.S. equities, and U.S. assets in general, because in addition to all the positives, again, huge fiscal spending, massive private sector investment, foreign direct investment, AI, again, transforming our economy. If you think about all of that, you also are going to have the United States operating against a backdrop of kind of somewhat weak China, but also a much more unstable or politically difficult China. Europe will be somewhat anemic, again, on a where else do you invest theme. Of course, you can invest around the world and people will, but the U.S. will, as it does today, be seen, I think, increasingly as the best possible investment, right? So I just think that overweighting the U.S., and especially if we get any pullback on a short-term recession, going much longer the U.S., and again, playing the Inflation Reduction Act, manufacturing chips, renewables, amongst other, playing parts of tech. Yes, our politics in the States are very dysfunctional. We see it playing out more dysfunctional. We're more divided than at any time, I would argue, since the Civil War. And that's all true. But the reality in this country is that we have the largest economy in the world. It's the most innovative, regenerative economy in the world. And our private sector, thank God for our private sector, our economy does well over cycles, regardless of who's in the White House. Sometimes they get in the way a bit, sometimes they help. But the truth is, our economy does well over cycles, regardless of our politics, and it will going forward. And again, I would argue that the setup, looking out to next year and beyond, for at least 5 years, once we get through some short-term pain, is absolutely the most constructive setup in my entire career for the United States.
Fantastic. So if you are that man on the moon looking down at the earth, you'd look at the U.S.
Absolutely.
Fantastic.
Absolutely, especially on any pullback.
Just kind of on the AI kind of trend or fad, this is kind of funny. I don't know if you've heard this term, but PDOOM. Have you heard of that term?
I have not. Tell me, what is it?
Apparently, it's it's according to the Wall Street Journal, the new Silicon Valley metric for the probability of doom caused to humankind by AI?
Yeah, I think that AI is not going to displace quite as many jobs as the most pessimistic forecasts might suggest, right? I think it is going to replace a lot of jobs, but also create new jobs, by the way, and create whole new industries. And in fact, 5 years from now, we're going to have, or 5 to 7 years, we're going to have the Google and Microsoft of AI, right? Meaning companies, and maybe it's some of these that are already helping to develop it. But it is incredibly exciting, and where I'm most excited is again how much it will transform the U.S. economy in a positive way.
How about the creator economy, trend or fad?
I think it's a trend. I do. I think that, COVID changed the world, but technology was changing the way we worked before that, right? The great thing about technology is when COVID hit, we almost barely skipped a beat in this country. The ability of companies and individuals to adapt so quickly to continue to function if you're a company, or to create and or make a living in new and creative ways, absolutely astounding. I think is a trend.
Okay, how about, this is one country we didn't talk about, India, trend or fad?
India is absolutely a trend. I think, India is one of the biggest beneficiaries of supply chain diversification out of China. India is a democracy. Modi's politics are getting, more repressive, I think, than a lot of us would like. But the United States has made its bet that India is a critical ally. Look, India knows their future lies with the United States and not China. In fact, most countries in the world, even in the global South, where China has, to their credit, entered this vacuum left by the United States to occupy elsewhere. Even those countries, if you really ask them long term, who are they going to bet with? It's the United States, and India is with us. India is a phenomenal. The fundamentals are phenomenal, and I think it's going to be one of the top outperforming markets over the next 5 to 10 years.
And then, all right, finally, Bitcoin, trend or fad?
Look, I think so blockchain is very real. I think the technology is real, and all the investments around it, are smart. And I think we haven't even yet seen all the benefits, anywhere near the benefits of blockchain and related technology. The currencies themselves, they're speculative, right? At the end of the day, and by the way, I think it's fine to have part of your portfolio, not a massive amount, but have some allocation in your portfolio to higher risk, higher beta, somewhat speculative investments, including cryptocurrency, right? I think if you're going to do it, I would stick to the most liquid, Bitcoin and Ethereum. But I think there is a legitimate case to be made there. But recognizing you could lose everything. And the Bitcoin ETFs will help. I think there will be approval for Bitcoin ETFs, spot ETFs in Q1, and that will help. But if you really want Bitcoin to become a true investment class, right, an asset class, crypto to become an asset class, these currencies have to become a store of value, and they have to become something that you can actually transact with, meaning I can go down to my local Starbucks and pay for coffee in Bitcoin as easily as I can with Apple Cash, or I can go to a car dealership and buy a car as easily as I can as writing a check or using a credit card. We're just, I think, still pretty far away from that.
Charles, thank you so much for your time. I feel like I could keep talking to you for hours. You know so much about different things. Thanks for being on the show.
Thrilled to be here. Always happy to come back.
What's the best way for people to learn more about you and your firm?
Great. Yeah. Thanks again for the opportunity for being on the show. And if you want to learn more about us, go to signumglobal.com, or you can always reach out to me directly, charles@signumglobal.com. We're a firm of 14 partners around the world. We're very nimble. We're incredibly client focused. And if you have any concerns in the macro or geopolitical risk space, we're becoming really the leading firm in terms of quantifying and analyzing that risk.
Fantastic. Thanks again, Charles. And I didn't call you Charlie once, so.
Chuck Schumer calls me Chuck, so there you are.
There you go. All
Charlie
right.
Any day.
And thank you all for tuning in to another episode of Trends with Benefits.